Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 1 of Efficient Market Theory Explained. Is the market really rational? Is the stock market as efficient as some experts claim, or is it possible to outperform it with a bit of know-how? This is the question at the core of Efficient Market Theory, EMT. EMT suggests that all available information is already reflected in stock prices, making it nearly impossible to consistently achieve higher returns without assuming additional risk. But what does this mean for your money and investment strategy? In this video, we'll break down how EMT impacts the financial landscape, explore its applications, and discuss what this theory means for everyday investors aiming to grow their wealth smartly. Whether you're a seasoned trader or just curious about how markets tick, understanding EMT could be a key piece of the investment puzzle you didn't even know you were missing. Understanding efficient market theory. You might have heard people talking about how markets work. Some say they're unpredictable, while others argue they follow certain rules. One major idea that explains this is called efficient market theory, EMT. Imagine a giant information highway where the latest news, trends, and data are always available. EMT suggests that because of this constant flow of information, it's tough to outsmart the market and predict which stocks will jump or dive in price. Let's break it down. Definition of efficient market theory. Efficient market theory is all about how information flows through the financial market. It states that stock prices reflect all available information at any given time. This means that it's nearly impossible for investors to buy undervalued stocks or sell overvalued ones because prices adjust almost instantly to news and data. The theory implies that trying to predict stock prices is like trying to catch a shadow, tricky and ever-changing. Key principles of EMT. EMT is built on 3 forms of market efficiency. Weak form efficiency. This is the most basic level. It suggests that all past market prices and data are already reflected in stock prices. So, looking for patterns in past prices won't give you an edge. If you're someone who loves studying charts and graphs of previous stock prices in hopes of predicting future movements, EMT says you're out of luck here. Semi-strong form efficiency. This form takes it up a notch. It says that current stock prices not only reflect all past information but also all publicly available information. This includes earnings reports, news articles, and anything else that can affect a company's performance. So, even if you spend all day reading news, you're still on the same boat as everyone else. Strong form efficiency. At the top tier, this form argues that all information, public and private, is already embedded in stock prices. Even insiders with confidential knowledge can't consistently gain an advantage. It's like a level playing field where even those in the know can't beat the market. These principles suggest that while you can try different strategies, consistently beating the market is incredibly difficult. Investing becomes less about outsmarting others and more about understanding and managing risk wisely. If you agree with EMT, you might believe that it's smarter to invest in a broad market index than to try to guess which stocks will soar. Historical background. The efficient market theory, often referred to as EMT, is a cornerstone of modern financial economics. It suggests that financial markets are efficient, meaning all available information is already reflected in stock prices. But how did this theory come into being, and who were the key players in its development? Let's take a closer look at its origins and how it has evolved over time. Key contributors to EMT. When discussing the formation of the efficient market theory, Eugene Fama stands out as a pivotal figure. Often regarded as the father of EMT, Fama formalized the concept in the 1960s. His groundbreaking paper, Efficient Capital Markets, a review of theory and empirical work, laid the foundation for what would become a widely debated theory within the finance community. Fama wasn't alone in this endeavor. Other economists, like Paul Samuelson, also contributed critical insights. Samuelson provided mathematical backing that supported the core ideas of market efficiency. Then there's Burton Malkiel, whose book, A Random Walk Down Wall Street, popularized the concept for a broader audience. To sum up some of the key contributors, Eugene Fama systematized the concept, providing a theoretical framework. Paul Samuelson offered mathematical support, enhancing its credibility. Burton Malkiel helped popularize EMT beyond academic circles. Evolution of the theory. The journey of EMT didn't stop with its initial formulation. Over time, the theory has undergone significant scrutiny and adaptation. Initially embraced by academics, it suggested that beating the market through expert stock selection or market timing was nearly impossible. This was a bold claim that ruffled many feathers in the finance world. As new data emerged and markets experienced fluctuations, EMT faced challenges. Real-world events like the dot-com bubble and the 2008 financial crisis prompted re-examinations of just how efficient markets really were. Despite these challenges, the theory has held its ground, though not without controversy. The financial community's acceptance of EMT over the years has been a roller coaster. While its core ideas remain influential, researchers and practitioners have expanded upon it, leading to offshoots like the adaptive market hypothesis. This evolution underscores the dynamic nature of financial theories in a constantly changing economic landscape. Today, EMT influences practices in portfolio management and investment strategies, reminding market participants that if they want to outperform consistently, they'll have to seek innovative approaches beyond merely relying on market timing or stock selection. Was EMT a leap too far, or a necessary step in understanding market dynamics? The debate continues, shaping how we view and engage with financial markets. Implication of efficient market theory. Efficient market theory, EMT, is a cornerstone of modern financial thinking. It suggests that all known information is already reflected in stock prices, making it difficult for investors to gain an edge or consistently outperform the market. But what does this mean for how we invest and understand market trends? Let's dive into this. Investment strategies. When it comes to investment strategies, EMT tells us that prices are always right, based on available information. This has big implications for active and passive investment approaches. Passive investing. This strategy involves buying a broad market index and holding it over time. If EMT holds true, then passive investing is a sensible choice. Why? Because prices already reflect all available information, so there's no advantage in trying to pick individual stocks. Active investing. Active investors try to identify undervalued stocks and sell them when they're overpriced. However, EMT suggests this is a tough game to win. It's like trying to find a needle in a haystack, where the haystack keeps moving. Many active managers struggle to consistently beat the market average after fees. Ask yourself, is it worth the effort to outsmart everyone else, or should you just ride the market wave? Market behavior predictions. Predicting stock price movements is often compared to weather forecasting. Both are complex systems with many variables. EMT teaches us that short-term predictions are mostly noise. The theory argues that since all current and past information is factored into prices, trying to forecast short-term changes is almost like flipping a coin. Long-term predictions. Over the long haul, the market tends to follow economic fundamentals. Here, EMT suggests that while individual stock prices may be unpredictable, markets as a whole are driven by larger trends, like GDP growth or interest rates. Think about this. If stock movements are like random ripples in a pond, then maybe focusing on the water's general level, the market trend, is a smarter way to go. Understanding these implications can help shape how we view investments and keep our expectations in check. Use EMT as a guide when crafting your investment strategy, and remember, the market is a wild ride but with some rules of its own. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.